Good start to the trading week. The index plummeted to its lowest in 5 months. This as investors weigh in on fresh regulatory risk. We are coming off the index's lowest level in 5 months, but with new investment instruments ready for the picking, will property stocks save the day? Here to share with us his insights, we have Matt Cabangon of AAA Equities. Hi, Matt. Listen, we opened in the green, and here we are again swinging to a loss, down 0.2%, closing in on that 7,500 levels. What is going on here?
Well, January has been a very eventful month, to say the least, for our local bourse.
We're about 30 minutes into the trading day here in Manila, and Danny is on top of the action over at the terminal. Dan, sell-off still not over.
Super not over, Jess. I mean, it's really worrying here because we're down 0.6% in just the first 30 minutes of trade. We're really closing in on that 7,500 support levels. But now we did see a report that yesterday we were already trading at 14.7 times 12-month forward PE. That's the lowest we've seen in several years. And financials are taking the brunt here, down 0.8%, together with holding firms. So the PSEI giving up 0.5, so actually close to 0.6%. So we ended Monday at 6,749. As you can see here on my terminal, 0.28. But that's actually not yet in bear market territory, which some analysts had feared would happen, especially after all those announcements we saw over the weekend, China's PMI, and also the WHO, which raised its risk assessment of COVID-19 to now the maximum levels. If you can actually see on my screens here, you're going to be seeing that First Metro Securities said that bargain hunting pushed the index up before noon break, but those gains were eventually erased with some of the fears getting the best of us. That surge right up here and then paring back those gains. But if I take you back, a bit further on, you're going to be seeing how we're definitely far from the levels that we had seen earlier on, at least from the start of this trading year. Let's talk about those bouncing and swinging, the SM companies. So, SMIC was the big performer of 2 days ago. So it surged up 6%, and then it was again heavily sold off. Does this have anything to do with MSCI rebalancing or, foreign funds just interested in this company? Is it really fundamentally driven by the earnings of the company?
I believe it's more of a trader's mentality.
The question was really the volatility on not just oil prices, but also possible geopolitical risks that this might happen again. Do you think that might cause a flight to safe havens or, again, another second, repeat of 2018 and a very cautious stance in the markets going forward?
I think generally our sense of the markets is, I think people are going to remain cautious. Obviously, in the back of their heads, I think the key issue will remain the trade war.
I had an interview with McKinsey, especially on digital banking, and we were discussing how the big banks have not necessarily, given out the capex for this shift, and they're still making a lot of money. BPI is, for example, opening more branches, and you've got others really focused on the loan growth rather than the digital push. As a second liner, are you planning to become a technology company that also provides, let's say, loans, etc., really pivoting towards that? Or are you still banking on our traditional methods, brick and mortar, which some analysts are still saying are still what we need in the country?